If you think this week in the U.S. stock market was just another routine stretch of green and red candles, then you're already missing what really happened beneath the surface. Because while most people were staring at price charts, waiting for breakouts, or panicking over pullbacks, artificial intelligence was quietly reshaping the financial battlefield in ways that won't fully show up for months, but when they do, they'll redefine winners and losers. This wasn't just another trading week. This was a positioning week. A silent accumulation phase. A moment where algorithms, institutions, and long-term capital made decisions that retail investors won't understand until it's already too late. And before we go deeper, if you're someone who wants clarity instead of noise, strategy instead of hype, and real insight into how money actually moves in the U.S. markets, make sure you subscribe to this channel right now, because this is where we decode what Wall Street doesn't explain. Now, let's zoom out. On the surface, U.S. markets looked calm. The S&P 500 held its ground. Nasdaq showed controlled strength. The Dow lagged slightly. To the average viewer, this looked like indecision. But to professionals, this was something else entirely. This was recalibration. The market wasn't confused. It was recalculating risk in an AI-driven economy. Over the past week, capital didn't leave the market. It rotated, and rotation tells you far more than direction. Money moved away from outdated safety narratives and into future productivity. That's not speculation. That's structural. Artificial intelligence is no longer a tech trend. It's becoming an economic engine. And this week made that clearer than ever. Earnings reports revealed something powerful. AI isn't just improving efficiency. It's redefining cost structures. Companies deploying AI at scale are doing more with fewer resources. That changes margins. That changes forecasts. That changes valuation models. And Wall Street noticed. Take a step back and think about this. For decades, economic growth depended heavily on human labor expansion. More workers meant more output. But AI disrupts that equation. Now productivity can grow without proportional increases in labor costs. That's revolutionary. And when productivity increases without inflation rising at the same pace, monetary policy changes. Central banks notice. Bond markets react. Capital flows adjust. This week, we saw early signs of that shift. Bond yields moved not because of fear, but because of recalibration. The Federal Reserve didn't panic. It observed. Inflation data cooled slightly. But more importantly, productivity data whispered something new. Efficiency is accelerating. And that whisper echoed across markets. Now let's talk about where this efficiency is coming from. Artificial intelligence spending is exploding, but not in the way headlines suggest. This isn't just about flashy consumer tools. The real spending is happening behind the scenes. Data centers, energy infrastructure, cloud architecture, chip manufacturing, networking, cybersecurity, and optimization software. These are the invisible pillars of the AI economy, and they're expensive. That's why companies like NVIDIA aren't just hot stocks. They're infrastructure providers in a digital gold rush. Every AI model trained, every enterprise deployment, every automation pipeline depends on compute power. This week reinforced that reality. Demand isn't slowing, it's compounding. And when demand compounds faster than supply, pricing power emerges. That's why margins remain strong. That's why guidance remains confident. But here's the critical part most retail investors miss. AI dominance isn't about one company. It's about ecosystems. Microsoft understands this better than anyone. They aren't selling hype. They're embedding AI into workflows. Productivity tools, cloud services, and enterprise ecosystems that businesses already rely on. That creates frictionless adoption. That creates lock-in. And when enterprises lock in, revenue becomes predictable. Alphabet, on the other hand, is fighting a different battle. Search is evolving. User behavior is shifting. But control of data remains a powerful advantage. AI-enhanced search isn't just about answers. It's about intent. And intent is monetizable. Apple is playing the long game. Less noise, more integration. On-device intelligence, privacy-first AI, hardware optimization. It's a different philosophy. Not louder, but deeper. Each of these companies represents a different interpretation of AI's future. And markets are pricing that divergence in real time. But here's where it gets even more interesting. Mid-cap and small-cap AI-related companies quietly outperformed this week. Not the flashy names, the infrastructure players. Data analytics firms, chip equipment manufacturers, software companies providing back-end intelligence. This is where institutional money often goes first. Because big funds don't chase headlines. They build positions quietly. By the time retail notices momentum, smart money is already managing risk. And speaking of risk, this week was a masterclass in how professionals hedge. Options data showed increased protective positioning, not panic. Preparation. This suggests expectations of volatility, not collapse. And that distinction matters. Markets don't crash when everyone is cautious. They crash when complacency peaks. Right now, caution is present, and that's healthy. Let's talk about sentiment. Retail sentiment is split. Some are euphoric about AI. Others are terrified of a bubble. That tension creates opportunity. Markets move when beliefs shift, not when everyone agrees. And right now, belief is in transition. We're moving from AI as hype to AI as infrastructure. That shift changes everything. Now let's address the elephant in the room. Jobs, yes. AI will replace certain tasks. That's inevitable. But markets aren't pricing mass unemployment, they're pricing efficiency. Companies that use AI to enhance workers, not replace them, are gaining ground. Output increases, costs stabilize, margins improve. That's bullish. And that's why investors are rewarding adaptation, not resistance. From a global perspective, the U.S. remains the center of gravity. Capital continues to flow into American markets because innovation density matters. Talent, funding, regulation, and infrastructure all converge here. This week reinforced that dominance. Europe lags in execution. Asia innovates but faces structural limits. The U.S. still leads in scaling ideas into global platforms. That matters for long-term investors. Now, let's bring this home. What does all of this mean for someone watching this video? It means you shouldn't chase noise. You shouldn't fear volatility. And you shouldn't blindly follow headlines. You should understand narratives before they become obvious. AI is not a trade, it's a transition. The winners will be companies that own critical infrastructure, control valuable data, scale intelligently, adapt faster than regulation. The losers will be those that talk innovation but fail to execute. This week didn't give us answers, it gave us signals. Signals that smart money is repositioning. Signals that AI is moving from concept to core. Signals that the next market phase will reward understanding, not emotion. If you're still watching, you're already ahead of most people. And if you want to stay ahead, if you want weekly breakdowns that cut through noise and focus on what actually matters, make sure you subscribe, because markets don't slow down, and neither does opportunity. The future isn't coming. It's already being priced in.